Good morning, everyone. And today we're going to be talking about retail banking. In the introduction, this is something that was not mentioned, but essentially when I came out of university back in 2010, I tried to get a job. And because I did a background in finance and law, I thought I'm going to be an investment banker. So I went to an investment bank in London and I said, look, I want a job. And he looks at me and said, look, great interview, but tell me, Janos, why will you stay with us? Why won't you go out and do your own bank? Now, this was at a time when I had a lot of debt and the only thing I wanted was a job to pay my bills. And so I was really sad to lose that job. 2 weeks later, eventually, I do join a new challenger bank in the UK. And this gives me a lot of the background of what I'm going to walk you through today in terms of retail banking and how this is fundamentally changing at this stage. So we're here in Korea and at the World Fintech Forum, and that makes a lot of sense. The world is looking east in terms of fintech development. When you look at trends, what do we have? We have North America, where VC funding in fintech got $1.8 billion at the last quarter, Q1. Now that's a 20% decrease compared to the year before. We have Europe, currently standing at 348 million. That's a 50% decrease compared to the quarter before. And then we have Asia. Asia is at 2.6 billion. This is a net increase of 30%. In other words, every single region in the world, perhaps with the exception of Africa, is decreasing its VC fintech investment, and Asia is growing and growing and growing. And there's different reasons for this, but really when you start looking at the rationale of it, and if you look on the banking space, what do we have? You have a huge disparity between online banking and mobile phone penetration. We had the presentation of Ellie from Samsung Pay, and if she's still here, I want a Galaxy S7 if possible, mainly because it was a great presentation, but also it showed one thing, that going forward, banking will be happening on your mobile phone. And at the back here, if you take the country of Vietnam, Vietnam has an amazing opportunity. And here is how it goes. Banking penetration is about 22% of the population. On the other side, mobile phone penetration and actually smartphone penetration is at 130%. So if you want to provide banking services, what are you going to start doing? You're going to build branch, or you're going to start doing it online, on your mobile phone. And Vietnam is a typical use case of why you're going to have digital banking going forward. China is another example of that. If you want to start banking people in China, and for any weird reason you want to do it analogically and build branches left and right, if you start building 50,000 branches in China, or even 20,000 branches, you're only going to reach 1% of the population. The only thing that makes sense to scale is to go digital. And so we're going to really start looking at retail banking and tell how it's been commoditized. Now, this presentation is only going to be on retail banking. I don't have the investment banking background. But I think this is also where a lot is currently happening, and typically it's where the press is looking at it, because retail banking is consumer and consumer is press, and therefore it makes for great headlines. Now, let's start with something fairly boring, but then down the line, what is a bank? Unlike a lot of fintech startups, banking is a highly regulated activity, and just the virtue and the benefit of calling yourself a bank is a regulated thing. If you look at Hong Kong, you're not allowed to call yourself a bank unless you're a bank. If you do so, it's written it's an offense. It's actually a criminal offense. You go to jail. In the UK, same thing. Calling yourself a bank, or actually even a bank with a C at the end, I think you see it here, is a regulated activity. And you need to get an authorization from the regulator to allow to call yourself a bank. In other words, you cannot just go out there and say you build a bank. This also means that from a development perspective, the future of banking is necessarily driven by regulation. It's necessarily driven by government support and vision. Korea, a few months back, had this vision of creating e-banking platforms for technology companies. But this follows a wider trend that has been happening globally. And over the next 15 minutes that we have, we're going to start talking about the UK, India, and China. And we're going to start off with China. All of these countries have had new retail banks license issued in the last 6 months. So China had 5, India had 11, and the UK had 4. So China is all about invisible banking, whereas India is about proportionate banking, and the UK is more about API banking. So let's start with invisible banking and what we mean by that. So we're going to start looking at the Chinese evolution and what's so amazing about China. So keep in mind, I came from the UK and I did a banking and was really pumped about this. I arrived in China and then really no one cares about this for one simple reason. It took the UK about 100 years to issue one banking license. It took China 70 years to go from a single bank in the whole country to over 40 banks, 4,000 peer-to-peer platform, and now you have another 40 banks in the pipeline. In other words, the scale and velocity of new retail bank being operating in China is at a scale that is not comparable to what you currently have in the UK. And now we're currently in that stage 4 of the Chinese market. So you all know these. The Bezos, the Zuckerbergs, the Larry Page of the world. We all said that the GAFAs, the Google, the Amazon, the Facebook, and the Apples will be the new banks. But who is actually currently doing that? Do you know who that guy is? No? All right. He's the CEO of Tencent. You know who that guy is? CEO of Baidu? That guy? There you go. So, Jack Ma, the BATs. So we talked about the GAFA being banks, but who actually hold banking license today? The BATs, not the GAFAs. Why? Because they're currently doing something brand new in China that is not possible elsewhere. And we're going to start looking at this because China is really developing something which is this idea of invisible banking. The way China started doing this is, we're going to illustrate that with the example of Ant Financial. And Jack Ma had a very powerful quote. And here is how it goes. There are two big opportunities in the future of financial industry. One is online banking, all financial institutions go online. And the other one is internet finance, which is purely led by outsiders. Now, the outsiders is typically the BATs. And the way they approach banking is, they take segment and product step by step, and they start building this up. Payment, Alipay. Wealth management, Yuebao. SME financing. All of this has been done, and eventually what do you have? You have every single function of a bank. It looks like a bank, but it's still not a bank. Now, the Chinese regulators, unlike other regulators in the world, have that capacity of saying, now you're going to become a retail bank. And this is when Alibaba had to spin off its financial activity and financial, apply for a banking license, which is called My Bank, and they rebundled every single activity they had under a single license. So let's think about how really it works, and why do we call this invisible banking in China? What does Baidu do? Baidu connects people and information, Alibaba connects people and product, and Tencent connects people and people. Now, those are great companies, and we know how successful they are. Tencent, at the last count, had about 700 million people which are currently using their services. But how do you make that better? How do you increase the tie and the link between the people, the product, and the information that all their users are searching? You simply add a fintech layer to all of it. Why do you do that? Well, it makes sense. In order for people to search for more information, get more value out of information, if someone searches for a restaurant on Baidu and searches how to get to that restaurant, why shouldn't you pay straight away on Baidu? After all, we know for financial product and services that 90% of your search starts online on Google, and then you start buying the financial product. If you want to connect people and product and sell more product, let's make the payment experience flawless and frictionless. So you create Alipay. But also you need merchants to start putting the products on the platform. So let's start financing so that they can sell the product on that platform. And finally, if you connect people and people, well, payment is actually a very social activity, especially in China, where you have the red envelopes. Because with red envelopes, you connect people millions of kilometers apart, families that have been disconnected because of the economic boom, and you reconnect them virtually for one single day. And therefore you create the red envelopes on WeChat. So this is a great thing, and every single of these activities are highly valuable and evaluated, but we have one issue, is that there's only so many friends you'll have, there's only so many restaurants you'll go to, and there's only so many products you'll buy. So the amount of data you'll actually be generating is limited. What is really exponential, however, is the amount of metadata you're creating. Why do you have that friend? Why are you going to that restaurant? And why are you buying that product? And this is step 2 of monetization in China. You start monetizing metadata. You start monetizing the context and not the content. And this is a very clear example. And I think 2-3 months ago, you had a conference in Hong Kong about the future of internet finance. You had the chairman of Alibaba. It was a conference which was only held in Chinese, and therefore there was few English speaking in that room. We had the opportunity of having translation, and one question goes something like that. Do you as Alibaba care about doing peer-to-peer lending? And he goes, no, I don't care whatsoever. It is not something I want to do because it's expensive. I'd rather sell a hotel room on the back of a credit score. Now, why is that the case? Because we all know here, for whoever is in banking, that banking is highly regulated, it's highly expensive. And you cannot really grow exponentially. Why? The more loan you originate, the more regulatory capital you have to post against, and therefore this limits your profit margin. So when a bank in the US uses a credit score to sell you a mortgage or a loan, a BAT will use your credit score to sell you a hotel room. Because every single time it sells a hotel room and makes $15 profit on that, it doesn't have to post regulatory capital against it. And down the line is all about experience. Next time you'll go to a hotel in China, you'll check in, and you don't have to give your credit card as a guarantee. Because if you trash the room, then they'll decrease your credit score. So the bottom line is about China, it's simpler to add fintech into the value chain than spin off a bank. And we did say that the BATs have banking license, but it actually has been a pretty difficult journey so far, and they're resolving it. And don't get me wrong, when an Alibaba is raising 3.5 billion in a Series B round, they'll have the money to fix the problem, but down the line, it's still not easy, even if you're that big. So WeBank is currently having problems, especially on the account opening process. They thought it would be way easier than it was, but essentially the central bank in China said, no, you cannot open remotely an account, and therefore they stalled the growth of WeChat. Why? Because if you now have to go to your branch to open your account, what's really the add value of digital bank? None. And then they start saying, okay, well, until we're going to be stuck by the regulators because we're bleeding the state-owned banks, literally, let's start creating non-financial products. And this is more as my example of that hotel room that can be booked on the back of your bank. And the last one is about selfie pay. Why can the UK or any else in the world learn about retail banking in China? I said when I started my presentation, I did a challenger bank in the UK, and my CEO at the time wanted to create a marketing stunt, which was, let's create selfie payment. So we went to the PRN FCA, the local regulator in the UK, and we said, we want to introduce facial recognition payments into Lintel Bank. The regulator looked at us and said, no, you're not doing that. Why? Because we don't know that technology. We don't understand the fraud level. In other words, what about twins? It's a bit the same idea of contactless payments. What if someone steals my cards? What if I take the selfie of someone and make them pay for my transaction? We couldn't prove them that facial recognition payment was safer than contactless payment, and as a result, we couldn't launch the product. 1 month later, Alibaba comes with Alipay, facial recognition, with a trial of 10 million people. It means that in 1 month, they had a transaction history of 10 million people, and they could check the fraud level of how risky facial recognition payment is. We could have then used that data to go back in the UK and tell the regulator, this is the fraud level on facial recognition payment. It is safer than contactless. You should let us go ahead and using it. Because the point of using technology is not about how fail-safe is it. It is about how safer it is compared to the previous method and technology you've been using. So, like I said, whilst in China it's all about invisible banking, in Europe it's all about API banking. And again, my narrative is that retail banking innovation will fundamentally come from regulation. So I'm going to talk about PSD2, which is the Payment System Directive 2 in Europe, which is really changing fundamentally the way businesses, the way banks make money and operate within Europe. And I'm going to take 2 examples. Step 1, interchange fee. Step 2, API banking. Step 1, about 12 to 17% of a bank revenue is based on the interchange. In other words, whenever you pay with a card, the bank will take a cut. I pay to a merchant a good or service for 100 US. Actually, the merchant will only keep 98. The other 2 is kept by the bank for having facilitated the transaction. That would have otherwise not happened did I not have that card. Now, that interchange fee goes from 2% to 0.2%. So what does that mean? It means that you're slashing the revenue source of the interchange for the banks that currently represents 17%. You need to find another way of making money than just using interchange, and therefore you need to reinvent your business model. What about step 2? Step 2 is about the API banking. And that's currently how a payment transaction really works in Europe, but actually I think you can look at anywhere else in the world. So I'm not wearing a skirt, but if this was me, this is how I would do it in front of my laptop. So I'm wearing a skirt in front of my laptop. I go on Amazon, I buy something, I ping my merchant, I ping the card scheme, I go into my bank, they authorize the transaction, they pay Amazon. It's a fairly lengthy process. So what does PSD2 say is, well, actually Amazon should be able to ping straight away my bank and we skip the host card network. And this is what also PSD2 is doing. It means that down the line in Europe, Amazon will be able to ping straight away your Barclays HSBC NatWest account when you make a transaction. In the same way that when you use your phone and you give authorization for an app to tap into your Facebook contact, the first time when you'll go on Amazon, you'll give an authorization for Amazon to tap into your Barclays account to start taking money away. And what do you start doing here? You stop using cards altogether.
You have 5 minutes to wrap up, please.
That's fine. India is about proportionate banking. Why proportionate banking? Because, as we all know, banking is terribly expensive. And in many, many ways, it doesn't make sense to hold a universal banking license to do banking activity when you have a small market. For example, in Hong Kong, it will cost you about $30 million to have a banking license, and that's just your regulatory capital. If you only have 100,000 clients, it's a very expensive game to play. So India figured that one out and said, okay, well, we're going to create niche banking licenses. We're going to create a payment bank, a savings bank, an SME bank, so that you can look at a very small fragment of your population, provide them banking services. You cannot do other activities, so if you're a savings bank, you cannot do payments. But you can do that. And because you do a niche, you have less risk. And because you have less risk, you have less regulatory capital, and you enter the market. And this has been working. In the last 2 months, India has issued 11 banking licenses. And actually, it has worked so well that in last week, 3 of the banks said, I can't have that banking license. It's too expensive. It doesn't work for me. Because a lot of what the payments bank is doing and the savings bank is doing, fintech startups are already doing it. And the whole business model and viability of it is currently changing. So what do we really have is that banking is being changed by its core by changing laws and markets. And the business model of bank is totally different now. That's a good thing. Because the chart you see here is actually a process map of a mortgage. You only want here to buy a house, but this is through the whole thing that a bank will have to grow to double check if you can do a mortgage. We're essentially simplifying that step by step. And the bottom line is that money has been digitized, and now data is monetized. And if you want to change banking at its core, you're not going to make money anymore on the interest spread. You'll make money on the data. A lot of banks are doing this, and currently we're buying the vision, we're not buying the cash flow. So who are the companies that have been very successful at making money on data? Google, Amazon, Facebook, Baidu, Tencent. They know how to turn that vision into a profitable cash flow, and therefore it makes a lot of sense to have had the BATs as the new retail banks. This was FinTech today, that's TechFin tomorrow. Thank you very much.
All right, any questions from the floor, please? Yes, sir.
The fractional reserve system is the critical groundstone, the interest differential between the depositor and the lender. And also, the deposit insurance is a very important element. But in our fintech approach, we just focus on the niche market, so we don't worry about this fractional reserve system and then also the deposit insurance.
So it's a good point. So fractional
Can you
reserve bank.
recapture the question, please?
Sorry?
Can you recap the question?
Yeah, okay. So it's the core of retail banking. So in order for a retail bank to work, because really a retail bank is a deposit-taking activity which is redeemable on demand, you need to guarantee that deposit. And the way you do that is, first of all, fractional reserve banking. And the other way is, if you ever really mess up as a bank, you still have a guarantee for it, right? Now, the issue is that this is limiting a lot of ways banks make money. And typically, the e-money wallets don't have that issue. So if you're an e-wallet provider, you actually have 100% reserve guarantee on the deposit. You're not allowed to play the deposit to make loans elsewhere. This also means that, therefore, you don't need the guarantee schemes to work because you already back, you cannot play with the money, so you cannot lose it. The second part, unless you do have bankruptcy and you have more debt, etc. But typically, that's how it goes. Now, China has been interesting on the deposit insurance scheme, because China wanted new banks to enter the market. But the only way to allow new players to enter the market is you need to prepare a way or pave the road for allowing them to exit. China didn't have deposit insurance scheme until 3-4 years ago. It introduced that so that by allowing the WeBank, the MyBank, the Ant Financial, to enter the banking space, if they were to ever fail, because down the line they don't necessarily know how to be a bank, we can exit them out of the market and prevent social unrest by having the deposit guarantee. So deposit guarantee is a key thing to allow new players to go in, because if it messes up, you still have someone to pay the bill.
Okay, well, thank you very much, Mr. Janos Barberis, founder, Fintech Hong Kong.